Hey guys, Rick and Mike from Heirloom Wealth Management Quick Hits. Right now, we're going to be talking about balance sheets, why they are so important, and why we like to see a fortress balance sheet. So, Mike, we look for investing in companies and equities. Why are we looking at a balance sheet? What is it, and how do a few of ours look?
Yeah, a balance sheet is essentially explaining the simple equation where assets for a company equals the liabilities plus the equity. The liabilities plus the equity, you're thinking about bonds that they have issued on the liability side. Equity would be the stock. And for the company, how they finance those assets is going to heavily influence the level of risk in the business. The more debt that they have, the more risk that they have. Also, the greater return potential for equity holders. The thing that we try to focus on, and we prefer to invest in businesses with what we describe as a positive net cash position, meaning if we look at the debt that the business has, the long-term portion of the debt on the balance sheet, and then compare that to the cash and short-term equivalents that the company has on the balance sheet. All else equal, we'd like it to be a positive number, meaning that the cash and short-term marketable securities are larger than the amount of debt. That provides a lot of flexibility for the business, and they can opportunistically during difficult times not only stay in business versus a company that's over borrowed or over leveraged is commonly the term that you hear, but they can reinvest for future growth, take out competitors via acquisitions to increase market share. And I think rather than investing in a business that's going to borrow to maximize the return on equity through utilizing too much debt, the benefits of being more conservatively financed and surviving during difficult times and being able to invest and grow during those times, those types of businesses, especially when we're investing over the long term, are the ones that we want to be tying our, those are the wagons we want to tie our horses to. So the important things for us, positive net cash position, all of the largest positions that we have in the portfolio are either net cash neutral, meaning when you compare the cash and short-term marketable securities versus the level of debt, they're either neutral or they have more cash. And to the extent that we do have businesses that we invest in that carry debt, we really focus on the strength of the credit ratings that they carry, which describes the risk of default for that business, their ability to tap debt markets if they need to raise capital very easily. The better the credit rating, the more easily they can do that, as well as the maturities. You don't want to see a company with a ton of maturities coming up in the near term, because then that means that they're going to be at the mercy of whatever interest rates and investors are willing to provide capital to that business, which is there's no guarantee that might be a good time for them to borrow money in the future. So ideally, you'd want them staggered over a number of years, many years, even more than a decade.
Just as your individual household net worth would be, you're going to get through a recession less unscathed if you have less debt and higher income, and if you're more likely to keep that job through a recession, then you're in good shape. So we use that example occasionally when we talk about balance sheets and why it makes sense. But generally, we don't want anything you guys own to have trouble getting through an unexpected downturn. We really like those to be, fortress balance sheets, and to be able to actually gobble up some market share if we did go through a recession. And it might even be a good thing to have some volatility. So that's balance sheets. I'm sure you'll hear more about that in the future. Subscribe below so you have updates when we get them out to you, and we'll talk soon. Hey guys, if you like that, click here or here to see other videos that we've recorded, and we'll see you soon.